It's 2021 and once again tax season. As many people begin to prepare their returns and use different softwares or do it by hand, I have a few quick tax saving tips that can save you thousands of dollars. Just 5 minutes, and these two tips might be huge benefits to you and your return. In this video, I'm going to highlight two tips. The first can benefit anyone who pays significant real estate taxes, and the second tip helps ensure that your deductions on both your federal and state tax return are optimized. Let me give you a little bit of background, and then I'll provide some examples that just show how much you can save. The federal government allows taxpayers to deduct certain everyday costs as a way of reducing how much of their income gets taxed. You start with your gross income, and then you reduce it by deductions. And these deductions can be one of two forms: what they call the standard deduction or a list of deductions called itemized. The standard deduction is prescribed by the government on an annual basis. Here's a quick chart of what they look like for the 2020 tax season. However, you have a choice of either automatically using this deduction, which is the simplest way to file a tax return, or if you have other deductions that can be itemized: charitable contributions, interest on your mortgage payment, property taxes, state income taxes, or maybe some significant medical deductions, you may want to consider actually itemizing your deductions for a year. What we're going to go through in these two tips focuses on these types of deductions, because at the end of the day, the more deductions that you have, the lower your taxable income, which impacts the total taxes that you're going to pay, both to the federal government and to the state government. We'll use an example where we have a joint filing taxpayer. Together they make $200,000, and they have charitable contributions of $5,000 for the year, mortgage interest on their home of $12,000, and then separately they have during the year $7,500 of property tax on their home and $15,000 of state income tax. If you're in a state like Maryland with significant property taxes on the homes, this is definitely something you want to be paying attention to. The rules changed in 2018 and said that even if you have all of these taxes, you may be limited to $10,000. You can't deduct more than $10,000 of both property tax and state income tax. So that in this instance, our total itemized deductions come to $27,000. Okay, so why does this matter? For federal, it doesn't matter whether or not you prioritize deducting in that $10,000 your property or your state tax. However, whatever you enter in the federal carries over to your state return. Most states do not allow you to deduct state income tax. They make you add it back. So if you want to get the biggest bang for your $10,000 deduction, you want that to be primarily your property tax first. Let me show you in numbers. We're going to compare itemizing with all state income taxes or itemizing those real estate taxes first. Again, our joint taxpayer is making $200,000. They're filing jointly, and we have the itemized deductions of $27,000 taken on their federal return. If they use their state income tax as that $10,000, they have to add it all back. And so on their state return, in this case, we're going to use Maryland, they have total income of $183,000 subject to tax. Whereas on the other hand, if they had made sure what they inputted first was those property taxes, then all they have to add back is $2,500. Their Maryland taxable income now is not $183,000, it's $175,500. The key here is in a state like Maryland, where you have a significant tax rate, we have at this tax bracket, they would be subject to 5% tax and then a county rate of around 3.2 in most of the counties in the area. That $7,500 difference gives you a $615 tax savings, all because you made sure that when you were filling out your form, you use those property taxes first. A lot of people look at their state income taxes, they're already on their W-2s coming in, and they use that and say, I don't need to add my property because I'm already capped at $10,000. Don't do that. More than half the states follow your federal return and add back that state tax, so using property taxes can be really beneficial. If your property taxes are higher than $7,500, the $615 just goes up. If you're in a state where their state and local taxes are higher than 8.2, your tax benefit goes up. Okay, let's go into the second tip. On the second tip, we're again looking at those deductions, but let's start with first understanding our federal return. We're again going to go ahead and use joint filers who have gross income of $200,000. And what they're deducting, in this case, we're going to use $23,500, a little bit of a different number, and I'm going to explain why in a second. Their total taxable income on their federal tax return is $176,500. Now, If you go back to the chart we just talked about, the standard deduction for a couple filing jointly in 2020 is $24,800. So in this case, it's actually better for them not to itemize their taxes, take the standard deduction, and their taxable income is $175,000. The difference here is clearly you want to standardize. It's a $1,300 difference. This couple would be at a 24% marginal tax rate on this income, so that's a $312 tax difference. But we're not done. What I'm telling you is that you do not want to make this decision based on only your federal return. You actually want to run your calculations under both scenarios because it can strongly impact what you owe to the states or don't owe to the states. Let me use Maryland again as another example. Different states have different rules as to how much they follow the federal return or don't. In the state like Maryland, if you itemize on your federal return, you have to itemize on your state return. If you take the standard deduction on your federal return, you have to take the standard deduction on your state return. So in this instance, same scenario, we're carrying our deductions through to our state return, except in the state of Maryland, the standard deduction is not the same as federal. It's only $4,650 for joint filers. So you have to follow the same method, but the values are different. Look what happens. I'm also going to include Maryland exemptions because there are some other deductions that you may or may not apply for. But overall, the state taxable income, if you were to itemize, is $176,500 in this example. Using the standard deduction, it's $195,350. So in this instance, all of a sudden, the answer is better itemizing. Now, how do you compare and contrast which way to go? You have to again look at what is the actual end of day tax liability. In this case, it's an $18,850 difference. Using Maryland state and local tax again of 8.2% is a total tax difference of $1,546. So here it's actually better to itemize, even though what you're itemizing is not as high as the standard deduction on the federal return. To really compare, if you're looking at these two scenarios, lay it all out. What I would do is run your calculation for your federal and your state tax return under the standard method, and then run it again under the itemize. Look at what your federal tax owed is under both methods. Here, I went ahead and ran the entire calculation through a tax return. My federal tax at the end of the day under standard was $30,090, itemized $34,02. Then I went ahead and I ran my state tax, and it was $14,767 and $13,269. So our standard was better for federal, the state is better for tax. Add them all up and see what is the lower tax liability. Here, it is very apparent that itemizing actually produces a much better answer. The actual tax savings is just about $1,500. As you prepare your return, keep these tips in mind because they can save you a ton of money.